All right, we're on learning objective 3.4. We're probably about halfway through this chapter. So in the next video, we're going to talk about accruals. We just did deferrals in the previous video. So now we're moving on to accruals. Okay. An accrued expense is an expense that you're going to incur, but then you're going to pay for it later. Whereas the deferred expenses, we paid the cash, then we had an expense. Now we're going to have an expense, but we're going to pay the cash later. Some examples of this would be salaries expense, interest expense, utilities expense, wages expense. We could throw that on there. Most of the time, you will see these two quite frequently when you're doing accrued expense problems. Okay, so let's look at this example. They're giving us Smart Touch Learning pays its employee a monthly salary of $2,400, half on the 15th and half on the first day of the next month. Okay, so I like that they gave us a calendar here because that's really great. So you can kind of see how this accrual is taking place. Okay. So during December, the company paid the first half of the salary on December 15th. And so this was it. They debited salaries expense and they paid them cash. We don't have to do an adjusting entry for this because it has been paid, it's an expense, and it's been paid at the same time. Okay. But that second part of the salary, we're not paying it till the first of the month. But technically, on December 31st, we have that expense. We have accrued that expense. Okay. So if we waited till January 1st to make this entry when we paid it, that $1,200 doesn't get put on the financial statements for the year end. Okay. So the other half of it will be paid on the first, but as of December 31st, we need to accrue half of that. So we would debit salaries expense and credit salaries payable. This is the adjusting entry, okay? That's your income statement account. Payable is your balance sheet account, okay? So you can see, remember, we're only doing adjusting entries because we are doing accrual based accounting, not cash basis accounting. If it was cash basis accounting, we wouldn't even make this entry. We'd wait till the first and we'd pay the salaries just like we did on the 15th. Okay. But we're doing accrual. And you can see in that calendar, if I didn't make this entry, all of these days of that salary would be pushed into the next year, not in the year it should be in. Okay, oops, I went too far. All right. So this is the adjusting entry. Notice end of the period, income statement account, balance sheet account, no cash. No cash was involved here. But then we're going to pay this salaries payable when it rolls around to January 1st. So on January 1st, which is not the adjusting entry, okay? This is not the adjusting entry. The adjusting entry was on December 31st. We are going to debit salaries payable and then credit cash, okay? Not expense because we recorded the expense up here. Okay, so the expense is on that year's. The salaries payable in several of these, if you look at them like the salaries payable held it, like it had a pocket and it held it until the end of the year. That way we get that expense on the previous year. We know who we owe. We're making everything right. It's actually fixing the income statement and fixing the balance sheet at the same time. Okay. So this is the entry. Sometimes they'll call this the subsequent cash payment after the expense has been accrued. Okay. All right, let's look at accrued interest expenses. So December 1st, Smart Touch Learning purchased a $60,000 building in exchange for a 1-year loan. Original entry, okay? This is the original entry, not the adjusting entry yet. Okay. So they come down here and they said the formula to compute the interest is as follows. This is simple interest, y'all. Okay. We won't get to compounding interest until we get to financial management. Okay. So just simple interest is principal multiplied times the rate multiplied times time. Why do we have this formula? Why do we have to have this time element? All interest rates are quoted at an annual amount. Okay. It looks like they said this was 2%. I didn't see that anywhere. Maybe that was somewhere else in the book, maybe. But I'm just saying 2% because that's 0.02 is 2%. Okay. We're only going to accrue 1 month's worth of interest. So we have to have this fraction 1 divided by 12. Okay. So that you can kind of understand, because you'll have some other things like this that will require a calculation. I'm going to pull my calculator up and kind of show you. I know you know how to do math, but just kind of showing you how you can put some of these in to have less rounding errors. Okay. So what I do is I'll take the 60,000 multiplied times the 0.02%. That's $1,200. That's interest rate for the whole year. We only need 1 month though. Okay. So we're going to multiply that times the fraction of 1/12. And I realize that that is just very simple. We're just going to divide it by 12. But what if it was 3/4? You know, even 2/4 or 2/3. Okay. Multiply by the top number first. Always multiply times the top number and then divide by the bottom. Okay. Yes, that's $100. We could have taken it and just divided by 12. We'd get the same thing, but sometimes these fractions will create a little bit of rounding error. If you put it in your calculator like that for the next one, it will help your rounding errors that you're going to have. Okay. So $100 worth of interest is all we're going to accrue for this. That's a really cheap interest rate. So this company has to record on December 31st. They're not paying this $100 of interest. They're going to pay it sometime in the next year. But for December 31st financial statements, we have to get this $100 on the books. Okay. Remember this interest payable, just like the salaries payable, is going to hold it till it crosses the year end. Okay. So that is your adjusting entry. Okay. They put it here in T accounts for us. Sometimes that's easier to see. The next one is accrued revenues. This might be the easiest one of the 4 categories of adjusting entries because you've already been making this entry, okay? You just didn't realize it, okay? So this is when a company has performed the service, but they haven't gotten the cash yet. Or the company delivers the product, but they haven't collected the cash yet. Most of the time, and this journal entry could be done at other times of the year as well. But if there is some revenue or something that we've earned and we haven't billed them yet, we are going to record this. We're going to debit the accounts receivable. You've been doing this one already. Credit the service revenue. That looks very similar because we've already made that journal entry a couple of times. Okay. If we were doing cash basis accounting, we wouldn't care. We would just, whenever the cash came in, that is when we're going to record the revenue. Okay. So right here, they said Smart Touch Learning is hired on December 15th to perform e-learning services beginning December 16th. The business will earn $1,600 monthly and receive payment on January the 15th. So as of December 31st, $800 is earned. So here's our adjusting entry. We're just going to debit accounts receivable, credit service revenue on that last day. This entry could be done at any other time, but if they are specifically talking about an adjusting entry, make sure you date it that last day of the period. Okay. All right. So here they're showing us the T accounts. We're debiting that accounts receivable for 800, crediting the service revenue. Okay. These other entries came from all those entries that we did, I believe, in chapter 2. Okay. So when Smart Touch Learning receives payment in January, the business will record the following entry. January 15th, they're getting all the cash. They're going to get every bit of it. Only part of it's going to go to service revenue because the other 800 we had was recorded as service revenue in the previous year. So again, this accounts receivable just holds it until the end of the period. Okay. Here is a summary of deferrals and accruals. I do like this. Remember, prepaid expenses and depreciation are kind of in that same category. So but the journal entry is very different than the other ones. But buying a building, buying furniture, all of those are technically prepaid expenses. We just don't handle them with the debits and the credits like we do the prepaid expenses. Okay. So that is all for section 3.3. Well, I said that was all, but here we have all of those entries that we just made. Notice they are all dated December 31st. These are every one of them. Notice none of them have cash. Okay. And so we've got all of those recorded. Remember your process that I told you. Okay. I'm just going to jump over here really quick in that process. Well, I thought I had it right there. All right, here's that process. And we just did that step 4. We did that right there. Okay. Then all of those adjusting entries are going to get posted to those accounts. So here you see all of those accounts, and we did some adjustments. These are, I believe some of these are the entries we pulled over from chapters 1 and 2. And they've got it right down here. You can see that everything balances. Okay, it has to. I actually like how they've done this. They've done this kind of with T accounts. This is the same way I would do it. I like getting all my assets. Sometimes I have to have 2 columns to get all my assets in, but when you're doing that, always leave yourself a bigger T account for your cash because there's a lot of things that affects cash. And then underneath that umbrella of equity, you see your capital, withdrawals, revenues and expenses. Remember, your revenues and expenses have their own financial statement, okay? Even though they're underneath that umbrella of owner's equity. All right, that is it for learning objective 3.4. And we'll pick up in the next video with learning objective 3.5. And we're going to do 6 and 7 all together.